Welcome to Guardian Capital's market outlook discussion for the month of November 2025. The agenda will be discussing four things. First, education, the thinking framework. Second, earnings. How has the earnings for the BSE 500 companies been for the current quarter? And three, valuation and expectations. In this, we'll be discussing how the market is currently being valued and what is the outlook going forward. And fourth, the sectorial view. Principle 1. Earnings growth determines 80% of returns. If you closely look at the table, we would like you to focus on the red circles where for the past 3 decades BSE Sensex price has grown at a CAGR of 11%, whereas the earnings have grown at a CAGR of 10%. So therefore we can strongly conclude that there's a high correlation between price growth and earnings growth. Principle 2. Revaluation growth determines 20% of returns. If you look at the example below, Asian Paints over a period of 11 years have delivered a CAGR return of around 13%, of which 80% have come from earnings growth and around 20%, which is 3%, have come from the revaluation growth. What's revaluation growth? In 2014, people were willing to pay 43 times for every 1 rupee earned by the company, whereas in 2025, the same people were willing to pay 61 times for every 1 rupee earned by the company. This is the revaluation growth. In this slide, we would like to highlight the importance of extra return generated. Let's just say you invested 1 crore lump sum at a rate of 11% for 30 years, you would end up with a corpus of 23 crore. However, if you earn 1% extra return, your corpus amount would increase by around 7 crore to 30 crore. And if you generate an additional alpha of 3%, which is around 14%, you would end up with a corpus of 51 crores, which is 122% more than what you would have earned if you invested at the rate of 11%. So this signifies the importance of staying invested for longer periods of time. Now moving on to the second aspect of agenda, the earnings slide. From the table, it is clearly visible that there's been revenue slowdown across market caps for the latest quarter ending June 25. If we look at BSE 500, for the latest quarter, the revenue growth was 4% as against its historical average of 9%, and for large caps, it's around 5% as against its average of 9%. Mid caps about 6% for the current quarter as against 9% for its historical average, and in small caps we've seen the revenue growth has been flat for the quarter. However, on PAT side there's been significant improvement, primarily owing to margin expansion resulting from lower debt levels. Third, valuations and expectations. Historically, companies have grown by a CAGR of 11%. However, over the last 8 quarters, the revenue growth has been slowing down, and for the latest quarter, the growth was just about 4%. And on valuation front, currently BSE 500 is overvalued by about 20%, large caps and mid caps by about 18 and 25%, and small cap and banking and finance by about 15 and 14%. And if we take an expected growth of about 10% for all the indices, given these sort of devaluations, the expected returns for the all indices over next 5 years is quite low and is between 5 to 7%. So therefore the overall outlook going forward, the earnings growth has been slow, the valuations have gone up once again with markets recovering, and in this scenario we think it is ideal to wait and watch. The last aspect of the agenda, sectorial view. Here, if you observe on valuations front, currently 70% of the economy is fairly valued and about 30% of the economy is overvalued. And on current revenue growth front, about 20% of the economy is growing faster than its historical revenue growth rates, whereas 80% of the economy is still lagging its historical revenue growth rates. Investments in the securities market are subject to market risks. Read all the related documents carefully before investing.